All right, we'll go ahead and get started with Accounting 101 for attorneys. That's an overview of accounting concepts and financial records for legal matters. A couple of housekeeping items. Everyone's muted, so if you have any questions, just hover to the bottom of your Zoom chat and you can see the Q&A. Submit a question. I'm going to try to answer them throughout the presentation. If I don't get to them during the presentation, then we'll have some time at the end. CLE will be provided if you didn't submit your bar number during registration. You can email our marketing email address right there on the screen, marketing@bbccpa.com. And after our CLE series concludes, we will send everyone our slides, and recordings of this presentation will also be available. A quick intro about me. My name is Rubik Yeriazarian. I'm a CPA, certified fraud examiner, and certified in financial forensics. I'm a principal here at B&V with 13 years in public accounting experience. I started in Big Four, worked at a boutique firm, and have been at Briggs for the past 5 years. Been working in forensic accounting and lit support my entire career. So I'll do fraud investigations, expert witness work, etc., and also lead our data analytics practice here. So today we're going to go over some basic accounting terms. We're going to go through some accounting principles, give a rundown of what accountants do. You see the spoiler alert, we don't all do taxes. I, in fact, hate doing taxes. I know enough to do accounting, but I really begrudgingly do my own taxes every year. Then we'll get into accounting for litigators. So for any of you who are litigators, a couple of helpful hints and items to keep an eye out for on your future cases. Then, as I mentioned, we'll have some time for Q&A at the end as well. But feel free to submit questions during the presentations, and I will try to answer them throughout. So we'll start with accounting terms. Fun fact, the trial balance has nothing to do with the trial. One of the favorite things that happened to me on a case I worked on, an attorney gave me this document and said, "Look at this. It says trial balance. What even is that?" And I was laughing in my head, and I said, "Well, I mean, it's just a financial report, so it's nothing nefarious, nothing to do with trial. So anytime I see a trial balance now in a case, I always think about that." But we'll see a trial balance, an example of a trial balance, a little later on in the presentation. So some common accounting vocabulary that you'll see on any financial records or accounting records. You'll see assets, liabilities, and equity. And in accounting, everything has to balance. So our assets equal the sum of our liabilities and equity. Debits and credits, those are what we make our entries with. So we either have to record a debit entry or a credit entry to make our account balance go up or down, depending on what type of an account we're looking at. A debit can make a certain type of account go up and a certain type go down. So we'll go through a couple of easy examples a little later on debits and credits. Financial statements. So you've probably heard of balance sheets and income statements or profit and loss statements. So we'll look at those. And then we'll also talk about some other reports that are commonly used in accounting, or that we encounter a lot even in litigation work, such as my favorite trial balance, and some other reports such as chart of accounts, general ledger, journal, etc. So our assets equals our liabilities and equity. If this isn't the case, then something's wrong with the financials you're provided, and you need to go ask your client or opposing party to give you financial statements that balance. So your assets is going to include things like cash, accounts receivable, inventory. Your liabilities is what you owe, like your regular accounts payable, if you owe an amount on a bill, a credit card bill, or any long-term debt. And equity includes capital retained earnings and your net income. So your net income flows into your equity section of your balance sheet. And then net income is comprised of your revenues minus your expenses, which comes from your profit and loss statement. So everything on your profit and loss statement should flow up into the balance sheet, which is why then the balance sheet formula of assets equals liabilities plus equity still always has to work because then everything must balance. With debits and credits, I mentioned earlier that a debit can make certain account types go up and certain types go down. So in any journal entry, you can't just have debits or just have credits. An easy example of one that we see here below is if a client pays you $1,000 for legal fees, then you are making the following entry. You're going to record a debit or an increase to your cash, or if you're sent them an invoice they haven't paid you yet, you're going to record that increase to another asset account, your accounts receivable, and then you're going to credit your revenue to increase your revenue. So in that situation, you're increasing your cash and increasing your revenue. Your client, on the other hand, they're going to be incurring an expense and spending money. So they're going to record a debit to an expense account to increase that expense, but then they're going to credit their cash account to reduce their cash. So you can have a debit and credit both increase an account, as was the entry that you're making. You can have a debit and credit do opposite things. It increases one account, like the client's expenses increase, but their cash decreases. At the end of the day, you must just always have at least one debit and credit in a journal entry, and then the net impact of those entries will net to zero. So as long as your debits equal your credits, then you're in good shape. So on the screen now, you'll see some basic financial statements. So your balance sheet is up on the screen here. This is a accrual basis balance sheet. So this balance sheet includes accounts receivable and accounts payable. If it was a cash basis balance sheet, you're not going to accrue any of those payables or receivables. So for instance, in the entry we looked at on the prior slide, if you're on an accrual basis, you're going to record your revenue when you invoice the client, even though they haven't paid you yet. If you're on a cash basis, you're not going to record that entry until you receive that payment from your client. So on a cash basis situation, when the client gets when you get paid by your client, you're going to record the increase in your checking account when the cash comes in, and at that point you'll record your revenue. So you won't have any accounts receivable on a cash basis financial. So on a lot of litigation cases, I might get tax returns, and attorneys may point to that and say, well, hey, isn't this good enough? You know, you have the tax return has a Schedule L on it. Why do you also need the balance sheets? Well, as you can see on the screen here, each account grouping is broken out into sub-accounts. So you can see there is, within your checking account, you have 3 different accounts: checking, savings, and petty cash. And so when you look at the tax return on the Schedule L, all you're going to just see is total cash consolidated into one line item. So in order to see a full breakdown of all of the accounts, that higher level of detail, you're going to need that balance sheet, because tax returns aren't built to handle all of that information. You need a balance sheet to see that. So one question came in: is the statement of owner's equity another category of financial statement? Yeah, it can be. So for companies that have a lot going on in equity, you might have a more detailed report of a company's equity. I'd say that is one that isn't as common. So your common ones that you're going to see are primarily your balance sheet and your P&L. One of the more common ones that's still not as common is the statement of cash flows. Some businesses look at that often if they're wanting to assess their sources and uses of funds, of cash. But from my perspective, whenever I'm working with a client, I'll typically just get a balance sheet and income statement, and then I'll get all of their journal entry detail. So I can essentially make my own cash flow statement in a much more granular fashion by looking at all the transactions and see how they flow into each account. So your profit and loss statement, similar, that's the second big financial statement that you'll see most often. You can see the income accounts here. Let me get the little laser pointer. So here's your income accounts here. And again, you can see that there's 4 different categories of construction income here, and then you still have separate reimbursement income in this sample company file. So on your tax return, you're just going to see a total income line item. You're not going to get that breakdown. So your actual profit and loss statement gives you a lot more detail than you'll just see on a tax return. On the P&L, there's 3 main buckets, really 4. So the first one is all your income, and then you have all your cost of goods sold, and the net of your income and your cost of goods sold gives you your gross profit. So for damages calculations, this is always a really good starting point. If you want to look at lost profits, you're looking at your lost revenues net of your avoided costs. Cost of goods sold is usually the best starting point for most companies, depending on how they record their financials, to look at avoided costs, because cost of goods sold is supposed to be the costs that run in line with your revenues. Now, you still could have other variable or avoidable costs within the next bucket of expenses, which we refer to as your selling, general, and administrative, or SG&A expenses. So that's going to include all of your other corporate overhead type expenses. Now, some of these could still be variable in nature, depending on a company. One that we see sometimes is commission. So if there is a commission program and commissions are a direct percentage of income, then commissions could be viewed as a variable or avoided cost as well. And then at the very end, you see this other income and expense. So this is kind of a little catch-all for small things like interest income. So if you have money in a checking account and you get that 0.1% return on that savings account, your interest income will come here. You don't want to really mix that up with your regular income, because it's really not part of your major business. It's a one-off thing that isn't really going to tell you, hey, how's my business doing? Hopefully you're not banking on that 0.1% return for your to meet your revenue goals. The other thing that you could have here is one-off gains on sales. So if you sold an asset and it's just a one-time revenue that you get that you want to keep separate from the rest of your books, rather than keeping it up here with your bread and butter types of income, you may include it in this other income bucket, just so the reader of the financials can see that, oh, hey, that's a one-off thing. That's not part of our regular financials. So on these reports, this is the account listing and the trial balance. So when you set up your books, you need to establish all of the accounts that you're going to use in your accounting system. So as you can see here, there's in this, this is the account listing from QuickBooks. It's also called a chart of accounts in some accounting systems. So you can see there's all these accounts that say, okay, these are my long-term liabilities. These are my equity accounts, my income accounts, my cost of goods sold accounts. So when someone created this QuickBooks company file, they said, hey, I want to be able to see income in 10 different, if I counted that right, about 10 different accounts. I want to be able to record my income in a way where I can break out construction income from design income and labor income, materials income, etc. So an account listing or chart of accounts is a really great place to look at a company's accounts that they've set up to understand how they intend to record their business operations. So this tells me that, okay, I've got all these different buckets of revenue. So then for each one, I might want to see, hey, are my job expenses broken up by those buckets of revenue? It's different things that as I look at this, I can understand what's important to this company on the revenue side, and then how much detail do they break out on their expenses. Some companies might just put a catch all other expense categories, accounts that they use to catch a lot of different miscellaneous expenses. Ideally, they're going to break it out a little more, but depending on how voluminous a company's expenses are, could impact how much they build out their different expense accounts on their account listing. So the trial balance is a little similar as the account listing. One thing that the account listing can do is it will tell you any account it can tell you any account that was entered into the accounting system, whether it was used or not, whether it's active or maybe it was deactivated. You can see all that within the chart of accounts or account listing. And in the trial balance, what it's going to do is tell you the balance of every account that's every active account at a given point in time. So this trial balance is as of December 31st, 2023. Here's the balance of each of these accounts here. So if you have any, if you want to know any account that was ever set up in the history of the books and records, that's where you'll still want to see the account listing. But if you want to just get a quick rundown of, hey, what's the balance of everything? Where are we at a certain date and time? A trial balance is good. One difference between the trial balance and your balance sheet and profit and loss is a trial balance is going to give you all of the accounts that would be on your balance sheet and profit and loss in one report. Now, the difference is, though, let me go back to our balance sheet real quick, or our profit and loss. On the profit and loss, you get a lot more breakdown of detail here, where you can kind of see even on your balance sheet, hey, I can see where the breaks in my financial statement are, where I go from my checking accounts. Now I have my total checking accounts. Now I'm in a different category. I'm in accounts receivable. Now I'm in other assets. And now I'm in fixed assets. Whereas on my trial balance, it's just giving you directly down, top down, without any breakout of what kind of an account am I looking at. So if you're familiar already with, okay, I know kind of what I'm looking for, and I just want to see everything in one report, a trial balance is really good. If you want to see the financials with a little more breakout, that's where your balance sheet and income statement is still going to be helpful. All of these are very common types of reports that I'll typically run if I get a new client and I want to just get a general sense of how a company's doing. These are some of those reports that I'm going to always look at. If you're ever deposing a company controller, this could be a good starting point to say, hey, I've got your trial balance. I've got your account listing. Tell me how you use these accounts. Tell me how you guys book entries for revenue. I see you have 10 different income accounts. I see you have these different cost of goods sold. How do you break out cost of goods sold into these categories? So it's a good kind of anchor exhibit that can be used to point to and then ask an accountant some specific questions around relating to your lawsuit. So the general ledger and the journal, these are two of our most detailed reports. A general ledger is going to include every single entry that rolls up into your balance sheet and income statement. So if you looked at an account balance and said, hey, I see my cash balance. Let's look at our trial balance. I see my checking account balance is 36,000 and I want to know how we got there. You would go to your general ledger and it will give you a rundown of all of the debits and credits to each of your cash accounts. Now, alternatively, the journal, what that does is rather than sorting all those transactional detail by account, it sorts it by individual journal entry. I oftentimes use both. If I'm using the general ledger, I use that to say, hey, I'm interested in certain accounts. I'm going to run down the general ledger and look and see what kind of activity I see in each account. But then later, I'll also look at a journal because that tells me, hey, I'm interested in this specific transaction. I can see that, I want to know more about this specific transaction. What are all the debits and credits related to that one transaction? So if I want to know that, I'm going to look at the journal report to look at the details of one specific journal entry. When you run each report, it's going to give you the full, for instance, if I run a general ledger for the full year, I get every single line item for the full year. If I run a journal for a full year, I'm going to get every single journal entry that was recorded in that year. So very, very important from a detail perspective. As a forensic accountant, I always want the general ledger or the journal, because that's what's going to give me all that transactional detail. That's going to help me understand why the balance sheet and profit and loss statement are showing what they're showing. So one more level of detail past your journal or your general ledger is your subledger. So as a comparison here, we can see this is our screenshot of our general ledger. Let's look at account, or this number field here. This is invoice number 1002. And it says, okay, for invoice 1002, I have $1,000 entry recorded as design income. If instead of looking at my general ledger, I want to look at my sales subledger, the sales subledger is going to give me more detail than the general ledger. And it also can give me every single line item on a specific invoice. For instance, this is just one entry on invoice 1002 for $1,000. But if I look at my subledger, I can see that there is like 15 or 20 different line items related to invoice 1002. The other thing that my sales subledger is going to give me is more detail, whereas I can see on my general ledger that this line item was related to blueprints, but I don't get these quantities, unit of measurement, sales price. I lose a lot of that additional detail that I need to get from my subledger. It's, you have to go to a subledger for some of this information because there isn't enough room in the general ledger for it. And for sales activity, you're going to have certain kinds of detail that you won't have for other subledger activity. For instance, you might have a quantity and a unit of measurement and a sales price for your sales subledger. But then if you have a subledger for payroll, it's going to be different. You're going to have hours, pay rate, some other kind of detail there. So the subledgers can be customized based on what detail you need. Common subledgers, you could have one related to your payables, your inventory, your payroll. The sales subledger is definitely one that we use a lot, just because that gets you that next level of understanding on someone's revenue or sales performance. Okay, we're switching into the next category of our presentation, accounting principles. You see our fun fact, the general ledger is actually quite detailed. I hope I explained that well enough in the past few slides. So there's 10 fundamental principles of accounting. I'm not going to go through all of these, but these are just some of those hard and fast rules of accounting, that principles and assumptions that we make when we're performing accounting work. So as an example on one of them, the matching principle here, we're assuming that revenues and corresponding expenses should be recorded within the same period. So this is really important when it comes to assessing a company's financials, because if I look at someone's profit and loss statement and I see revenues of $1 million and cost of goods sold of $500,000, I want to know that, hey, is my gross profit of $500,000, is that a really good number? Can I trust that that $500,000 in cost of goods sold relates to that $1 million in revenues? If not, it's not really giving me a snapshot as to how am I performing related to that $1 million. I need those expenses to be recorded within the same month that I'm recognizing those revenues. Otherwise, what if the next month, what if I really had 800,000 of expenses, but I only recorded half of them this month and I record half of them next month? Well, this month, when I look at my financials, it's looking really good because I'm looking pretty profitable. But then when I look at my next month's financials, I'll notice that, ooh, I have all these extra expenses. What happened? You need to be able to record them in the same period so you can most accurately see how your revenues are doing within that period. So as I mentioned before, you guys will get these slides if you want to see any more detail on any of these assumptions. Again, the matching principle is one of those ones that are very key when you're reviewing financials. If anything looks off, if you're looking at a profit and loss statement and gross profit is swinging wildly, or your gross profit percentage is swinging wildly from month to month, then that could be an indicator that, hey, maybe they're not recording all of their cost of goods sold related to those revenues within that same time period. So other accounting guidance, you may see the term GAAP a lot. So GAAP means generally accepted accounting principles. I'll see GAAP a lot in some legal documents, and we always wonder, well, did the attorneys know what exactly they wanted when they say, hey, these financials have to be in accordance with GAAP, or does that just sound really good? So here, this is the GAAP hierarchy. So this is kind of level of hierarchy on different kind of statements that are put out by different governing bodies. So the FASB is the Financial Accounting Standings Board. They'll put out different FASB statements. And in the AICPA, the American Institute of CPAs, will put out opinions as well. So that's our highest level of within the accounting guidance hierarchy. Aside from that, there's other things, technical bulletins and statements of opinion, etc., that will weigh when determining how to account for certain things. So these are the types of things that company controllers or chief accounting or chief audit officers have to look at within an organization. If there is some change in accounting policy, they need to really understand, hey, for our business, how do I most properly record these revenues or these expenses or recognize these assets? So that's something where they're going to need to look at the latest pronouncements, GAAP pronouncements, look at the latest FASB statements or AICPA opinions that pertain to their company, so they'll be properly accounting for the books and records at of their company. So aside from the accounting guidance, our professional standards, CPAs have to follow the AICPA Code of Professional Conduct. 4 main pillars: professional competence, due professional care, planning and supervision, and sufficient relevant data. This is one that comes up a lot on litigation matters because we need to make sure we have enough data to give our opinions. So a lot of times when we have these really big document requests or requests for productions that we want from the opposing party, we need sufficient data to base our opinions on. And so that's why we may ask for certain things, because that's one of our 4 standards there. Specific to forensic accounting, there is another standard called SSFS1. It mirrors a lot of the language from the AICPA Code of Professional Conduct, but has some additional guidance specifically for forensic engagements, including both lit support and investigations. It used to be called SSCS1, but then it was a little hazy as to, okay, well, SSCS stood for Statement on Standards for Consulting Services. They split out more general consulting services from forensic consulting services. So about a year and a half ago, SSFS1 came out specific to forensic. Okay, so what do different kinds of accountants do? Fun fact, you may think you need an audit, but you don't. I don't do audits, but a lot of people call me and say, hey, we need you to audit these books. And I always have to say, oh, okay, well, thanks for calling. Just to clarify, we don't do audits, or I don't do audits. What do auditors do? Auditors could do a formal external audit where the end result is an audit opinion. So we capitalize the A in audit because that means a very specific thing to accountants. Auditors can also do a review or a compilation. On the next slide, we'll get into a little more detail on the differences between these. Tax professionals, tax accountants, they're going to do your individual tax returns, corporate returns, and all those other types of estate returns and all that. And then you have your consulting buckets. So that can include internal audit, forensic and litigation support, like I do, valuation, and really the field of data analytics has really been growing the past few years as something that more and more accountants are doing. Previously, it was more of a data science type field where it was more maybe computer science or data engineer, but a lot of that is being blended into what accountants are learning in college now as part of their curriculum. And it's really becoming that expectation to be able to handle a lot of data as accountants. So when I was talking about audits, you might see audit or financial statements audited or unaudited. So these are three different levels of assurance that auditors can provide in performing these kind of engagements. So if you do an external audit, the auditors are performing analytical procedures to determine if they're able to obtain reasonable assurance that financial statements are free of material misstatement. So this is your biggest amount of coverage, you're doing the most, you're doing the audit, you're auditing everything. And at the end, you're going to give a letter that says, yep, I reviewed the financials, we did a full-on audit, and it's free of material misstatement. Now, if you do a review, what's different there is that a review isn't as in-depth as an audit. You're still going to be doing some analytical procedures, but you might say, for instance, hey, I don't need a full-on audit. For this company, the biggest thing that I'm worried about is their inventory. So I want to just do procedures on inventory. I know I'm not going to get a letter saying, hey, we did a full-on audit and everything looks good, but if you're worried about one specific area, a review might be something that you want to ask an auditor to do. And then the lowest level is a compilation. So I see these a lot in litigation, and opposing counsel might say, well, hey, look, here's these financials from the auditors. A compilation means if you want me to do a compilation for you, you give me your shoebox, or you give me your spreadsheet where you keep track of all your entries and all that, and then I'll make it look like financial statements. I'm going to take what you give me at face value, and I'm going to generate a balance sheet and a profit and loss statement, but I'm not going to challenge any of the numbers that you're presenting. In an external audit and review, there's procedures that are done in order to test the numbers you're giving me. But in a compilation, I'm just going to take what you're giving me, and I'm going to take your word for it and say, hey, here you go. I helped you put together that what you gave me in a financial statement format. If you get if it's a compilation, a compiled financial statements will have a cover letter on it that'll have all that caveat language of, hey, we didn't do an audit, we didn't do any of those procedures, this is just a compilation. So that's definitely something that I see a lot of times in litigation, where a party says, oh, look, we had these outside accountants do this. But if what the outside accountants did is a compilation, that doesn't really add, that provides zero assurance. There was no audit procedures done on it at all. So that's something to look out for if you see that on any engagements. So our last section, accounting for litigators, we'll go into just some things on how you can, just some tips and tricks that we've seen in our experience in the litigation world. Fun fact, accountants love Microsoft Excel. I actually have a coffee mug. Let's see if it'll show up in the picture. It says, I love spreadsheets. That's how much we love Excel. Use it every day. It would be a sad day if I didn't use Excel. So Excel is, if we can get things in Excel format, or if we ask for a native format, native Excel format, instead of a PDF, it's so much easier to really dive in immediately and analyze that data. So with a PDF, you not only have to convert the PDF, but we'll go into some, show some examples on why your data could be limited if you provide a PDF and not a native Excel file. Also, in a worst case scenario, if we get PDFs and we can't digitally convert them using some software or technology, then we get into manual data entry. That's the worst. We hate doing that because then it's going to take, a week of time just to get everything in Excel. So then we can determine, okay, is our data complete? Is this what we need? What do the numbers look like? We're spending a lot of time and money on just doing something that a client should be able to easily, instead of clicking export as PDF, just export it as Excel. Very easy to do. Also, when we work with QuickBooks, companies who use QuickBooks, we always want to try to get a QBB backup file. So the beauty of the QBB file is if I get that backup file, I can load it up in our company's instance of QuickBooks, and I can just run whatever reports I want in there. I don't have to give a detailed PBC list to say, hey, I want you to run a general ledger, but when you run it, make sure you run it like this. And I'll show some examples of what different fields could exist within a general ledger, where a standard general ledger report might not give us all the fields we need or show us all the detail, or it even could be restricted to hide certain fields of relevant information that we could otherwise generate from straight from that QuickBooks backup file. So it could really make that document request process a lot more efficient if we have immediate access through that QBB file. We don't have to worry about cutoff fields. I'll show an example of that on the next slide. And as I mentioned, if we can go in and add any field of data we want that exists within QuickBooks, so that way we can make sure we're not missing anything. So, sometimes what I'll see is that, oh, okay, I have a memo field, but then there may be another note field or a second memo type field that's used to really keep track of some, in the most nefarious situation, if you say, oh, hey, these are office supplies, that's what it's going to say in the memo field. But then in your notes field, it's going to say, just kidding, that's for my, personal expenses I'm running through the company. It's not always that clear cut, but that's the type of thing we can look for if we have access to all of the fields of information within QuickBooks. So with cutoff fields, you can see this top one is a export as a PDF. So it's the same general ledger detail. The top one is exported as a PDF. The bottom one is Excel. So if you see this ... here, that means something's getting cut off. So if we compare to our bottom one here, we see the first line says, hey, this is East Bayshore Auto ... Well, if I had it in Excel, I could see that the full name of that vendor is East Bayshore Auto Mall. State Board of Equa. If I go down, I can see, okay, that's State Board of Equalization if I have the full report here. In the memo field, that's the field that can be really long. So you can see here, it says, oh, this is for, I'm paying East Bayshore Auto for my monthly truck, ... Well, what if you had the actual Excel-based GL and you saw, well, it's the monthly truck payment for my mistress. So that's the kind of information that can easily be cut off within a PDF, where if I then have to say, hey, I really want to know what that monthly truck payment is for, then you get into a discovery battle of, well, we already gave them the full general ledger. We gave them thousands of pages of general ledger PDF data. They have all the information. They're just being difficult. Well, it would sure be interesting if I knew that that monthly truck payment was for your mistress and it wasn't really for the company. So these kind of fields then also, as I mentioned, could be hidden. So if I'm exporting something to PDF, you have to make everything fit. So maybe whoever is exporting that general ledger, if it's the opposing party who's generating it and responding to a request for production, maybe they say, hey, I'm going to hide that memo field because otherwise everything else won't fit. It won't fit on one page across. So I'm going to hide that field just so everything fits. But then you lose all that information as to, well, what does this payment actually relate to? That memo field is really key when we're looking at transactions to give us that better understanding of, well, okay, what is this really for? And I just added that memo, that mistress thing after the fact. That's not what it really said in the QuickBooks file, but you get the idea of what it could say if you have all this extra information at your fingertips. So with additional fields to include when you're running reports, one of the things I always like to include is this class field. So what the class does is, the class is a way for a company when they're setting up their books to say, hey, I want to be able to see my performance by class, by this different business unit. So on this profit and loss statement here, we can see that there is these headers at the top that says new construction, remodel, overhead, unclassified. So this company used the class field to differentiate their activity if it's related to their new construction projects, remodel projects, general overhead, or anything else that's a catch-all unclassified. And so at the general ledger detail, you can see that there is this class field here where they've indicated, oh, hey, here's that category or grouping that these transactions relate to. So if I want to know, hey, I see these blueprints, are these blueprints related to a new construction or a remodel? If I have the class field populated, I can immediately see that. If I go back to my standard general ledger output, I don't have a class field on here. So that's one of those that when you're running the report, you need to add it. You need to add it to see, hey, is the company using the class field? And that gives you a lot more insight as to how you can run your reports to get some better information, because it's a lot easier, especially relating to a lawsuit, if you say, hey, we want to talk about the new construction side of things only. Well, if a company is already booking all their entries related to new construction using this class field, you're one step closer, a lot easier, by at least saying like, okay, I don't have to figure out what's related to new construction. I can run a report in a way where I can easily see, hey, these are all the revenues and expenses you coded as new construction. Then you may have to still go in and say, okay, did they properly code everything? Let me look at my overhead or unclassified buckets and see if there's anything that I can attribute specifically to new construction, or maybe those are the things that I'd ask about in a deposition as to, hey, are these other expenses that are in overhead just related to new construction, or are they allocated to, or do they relate to everything? So it's something simple like that, that if you have that QuickBooks backup file, it enables you to run that report yourself with that additional level of detail, and it's super helpful. It saves a lot of time. So having the QuickBooks backup file also helps you maintain the element of surprise. So two reports we run frequently are the audit trail report and the voided and deleted transactions report from QuickBooks. So if I'm asking for an audit trail as part of a, or if I'm asking you to ask for one through a request for production, then the client may say, well, what's an audit trail report? And if they try to run it, then they'll realize, oh, shoot, I don't want to send them this, because what an audit trail report shows is it includes timestamps of every entry, including your original entry, when you modified that entry, and when you deleted that entry, along with who did it, when exactly they did it, with the exact, date and timestamp. So if you're looking to say, hey, did these people go in just before this loss or just after this lawsuit was filed and mess around with things, if they run an audit trail report and maybe they didn't realize, like, hey, I didn't know our system did that, the audit trail is going to tell us all that information. So really helpful report to be able to run there. So especially if there are significant dates within your case where you want to see, hey, do I see any kind of activity within certain periods of time? We use the audit trail a lot to be able to evaluate that kind of thing. The other one is the voided deleted transactions report. It's similar to an audit trail, but it only shows any transactions that are voided or deleted, not your modified transactions. So where it's helpful to have both is, we'll run both of them just to get an idea of, hey, how much stuff is changing, or how much stuff is just flat out being deleted. There's a lot of legitimate reasons to delete transactions. Hey, I started posting this and then it was wrong. So instead of modifying it or fixing the vendor, I just straight up deleted it and recorded a brand new entry with the correct information. So that's legitimate. But in other instances, we've seen where someone is booking an entry, booking a revenue entry and then deleting it. Well, if there was no reason for it to be deleted, could that have been deleted because, hey, when the cash comes in, I'm going to pocket that cash, and before I pocket the cash, I just need to make sure that the revenue isn't on the books, because if someone sees the revenue on the books, they're going to expect to see the cash relating to that revenue as well. So within the audit trail as well, if there is any changes, what's interesting to us always is, hey, what are they changing? Are they changing a specific detail related to a transaction to make it look like it was related to a certain type of expense, but now it's being coded to a different type of expense? So that's something that's why we'll always look at both the audit trail and avoided deleted transactions report, just to see what sticks out to us. And then we can go over that with the attorneys or the client to say, hey, is there something here around these kind of changes happening that are relevant to this litigation, or anything jump out to you? If I said there's a bunch of changes happening on this specific date, does that jump out to you as, oh, hey, that's interesting because that's right when we filed, this motion, or that's right before we did this? Question as to if you can tinker with the Excel files, how do you prove up your evidentiary trail? So if I have the full QuickBooks backup file, then I can run those Excel reports myself out of QuickBooks. So that's one way to make sure that it wasn't tinkered with. If there is a client provides the Excel itself, that's where you can lose some of that, because if they provide an Excel and they changed an account, what you can do is try to then reconcile that Excel general ledger to the client's provided profit and loss statement. It's good to try to get contemporaneous profit and loss statements from monthly or annual reports, because that's where you're going to get that unaltered financial. So for instance, let's say if there was something that was coded as a office supplies, but then it was changed to cost of goods sold within the Excel output of the general ledger. Well, if I'm just looking at the general ledger in Excel, I'm only going to get whatever was modified. But if I am trying to reconcile that general ledger to the actual contemporaneous financial statement that the general ledger detail relates to, I'm going to see that I'm off. I'm going to see that my general ledger Excel file doesn't agree with my financial statements. So that will tell me that, hey, something happened here. What's up with this change? And that's where maybe I can ask for, hey, can you run this again? Or if you can run a version straight out of the system where you might tell that, oh, okay, well, hey, it's not modified in the system because the system is still giving me the correct detail that ties to my financials, to my profit and loss. So that means it must have been modified outside of the system if there is no modification in the system at all. Good question. So two great reports that we run a lot of times on litigation cases. And overall, biggest takeaway on this section, I'd say, is Excel is our friend. An accounting system backup file or even remote access to an accounting system is our best friend if possible. I know that's not always available in a lot of cases, but anytime we've gotten that actual QuickBooks backup file or access to the accounting system to where we can run our own reports, it makes things so much easier, and it just gives us a lot of advantages as far as being able to run the best reports that we can. So that's all I had. Before we get into any additional questions, I'll give you a quick note on our upcoming CLE events. in September. So we have big game hunting on September 16th about ransomware. And in the following week on September 23rd, we have Business Valuation 101. So it'll be like this Accounting 101, but related to business valuation. And then next month as well, we have a fireside chat about using data to support your cyber and IT strategies. So if anyone has any other questions, feel free to submit it in the Q&A. You can also email me at rubiky@bbccpa.com. We will be sending the presentation out after the end of the month. We'll have the slides that we can send out to everyone. But any other questions that anyone has, please feel free to send your questions. And I'm only going to assume that everyone laughed at all my accounting jokes, because deep down I was really laughing at them, but everyone's muted, so that's probably the only reason why I didn't hear you chuckle or groan. So there was a comment to some emailed questions, and I appreciate that you laughed. If I didn't see those questions earlier, but what I can do is we can reach out, we can get answers to your questions and reach out to you individually. If anyone does have any specific questions like that they don't want to ask through the chat, again, feel free to shoot me an email at rubiky@bbccpa.com, and we'll be sure to answer those questions. One question about accounting systems. What other accounting systems do clients use other than QuickBooks? So what we see oftentimes, QuickBooks is a really common one. We see a lot of Sage, Sage Intacct, or it used to be Peachtree, then became Sage. So we see that oftentimes as well, and Microsoft Dynamics, and also NetSuite. So those are kind of all the middle level accounting systems. QuickBooks is definitely really easy to get that QBB backup file on. With the other systems, we've typically asked for some kind of remote access, because it's not as easy to load in that kind of backup file like QuickBooks is. Plus, for us, we have a bunch of QuickBooks licenses, so it's super easy for us to load that in on our end. Okay, so the question, how does government accounting differ from commercial accounting? What types of reports are available regarding nonprofits? And what accounting records should be kept by local government corporations? So, I know, so there's a different kind of high level. There is accounting in governmental and nonprofit organizations. There's fund accounting. So you're really having to segregate the source and use of funds based on where the money came from and what it's earmarked for. So that's one big difference. As far as types of reports available, I'm going to defer to our governmental and non-for-profit leaders. I can get them to answer that question a little more in depth and send you a more detailed answer on that. I know there are some different types of tax returns and forms that they file. There's a website called, I think, GuideStar, that you can access certain nonprofit financial information from, but I'll get a more detailed answer for you on that one. Anything else? Well, I hope this was helpful, and I hope no one's going to use this against me in cross-examination in the future. But if you do, I'm totally fine with it, because I'm very comfortable with everything that we've covered. So again, I hope you guys are able to attend our future CLE events later this month and in October. We also can do this if you feel like this would be helpful for your whole organization. You can shoot us an email, and we can do the same presentation for a wider audience at your own firm as well.